when you are looking at a company's financial report, you generally expect to see, steady incremental changes.
Right, like a 3% bump in revenue here, or maybe a slight dip in operational costs there.
Exactly. It's usually a landscape of very mild hills and valleys. But imagine you are scanning through a quarterly report and you suddenly hit a mountain that it shoots straight up into the stratosphere.
Oh, wow. Yep.
Okay.
Yeah.
I am talking about a company growing its revenue by 849%.
Wait, really?
Yeah, and that is not over a decade. That is in a single quarter.
Geez. I mean, it completely breaks the scale of whatever chart you happen to be looking at, right?
Totally.
Because an 849% jump isn't just, business growth. It's like a structural mutation.
Yeah, that's a good way to put it.
And when you see a number like that, it forces you to ask a very specific question, like, are we looking at a sustainable hyper-growth business model, or is this just a spectacular temporary flash in the pan that's, going to burn out as quickly as it ignited?
Right, and that staggering number is exactly why we are focusing today's deep dive on RedCat Holdings.
Ah, yes.
RCEAT.
Yep. For those of you following the defense tech space, you might know them by their ticker RCE. They are a micro-drone manufacturer that has suddenly started landing some incredibly major military contracts.
And they're definitely making waves right now.
For sure. So our mission today is to figure out what this company actually is. And to do that, we are combining RedCat's recent SEC filings, some Wall Street analyst notes, and their internal insider trading logs.
Which are super revealing, by the way.
Oh, absolutely. Because we want to know if you are looking at the next undisputed giant in defense technology, or, well, if you are looking at a brilliantly disguised speculative trap. Yeah, and the documents reveal the ultimate dichotomy in the market right now. RedCat is effectively living two entirely different realities at the exact same time.
How so?
Well, in one reality, they are experiencing explosive, undeniable, real-world growth driven by these massive military programs.
Right.
But in the other reality, their current financial foundation is, to put it mildly, a massive cash incinerator.
Okay, let's unpack this because we have to start with the bull case, right? We have to understand why people are looking at that 849% number and getting so incredibly excited.
Yeah, the top-line growth is absolutely tangible.
Exactly. When we look at the raw SEC filings, the sheer volume of money suddenly flowing into RedCat's top line is honestly breathtaking.
It really is.
In their first quarter of 2026, which ended March 31st, they brought in $15.5 million.
Right, and compare that to the previous year.
Yeah, in the exact same quarter of the prior year, they brought in just $1.6 million.
That is just a massive structural shift for a small startup.
Right, and it wasn't just a one-off anomaly either. Their full-year fiscal 2025 revenue grew 161% year over year.
Wow. And understanding why that money is flowing in is, it's arguably the most important takeaway for anyone analyzing RedCat right now.
So where is it coming from? Is it some, magical new tech?
Well, that's what's fascinating here. When you look at defense companies, it is natural to look for a proprietary technological breakthrough, right? You assume they have some unbreakable encryption code or, I don't know, a drone propeller that somehow defies the laws of physics.
Sure, you expect a James Bond gadget.
Exactly. But their actual competitive advantage, their real moat, is their government relationships.
Okay, specifically through their subsidiary, Teal Drones, right?
Yes.
Because RedCat was selected as the provider for the U.S. Army's Short-Range Reconnaissance Program, the SRR program.
Yep. And in the defense world, securing a program of record designation is, well, it's the absolute holy grail.
Why is it such a big deal compared to just a regular contract?
It is the difference between a one-time transaction and a permanent partnership. A program of record means you aren't just selling the Pentagon a batch of drones once. It means your hardware has been written into the structural, long-term procurement pipeline of the United States military.
Oh, wow. So they're basically locked in.
Exactly. And to understand why this is so lucrative, you have to look at how modern warfare is fundamentally shifting. The military isn't just buying these small-scale drones to use as, specialized spy equipment anymore.
Right, they aren't just for special ops.
No, they are treating them like ammunition. They are cheap, disposable, and basically necessary for every single infantry squad to see over the next hill.
So they just churn through them.
Yeah, that means the Army needs thousands of them, constantly replenished.
Which explains the sheer velocity of the orders we are seeing in these filings. Because just in May 2026, Teal Drones landed a $9.5 million purchase order under that exact SRR program.
Right, that's a huge chunk of change.
And it's not just the Army. They also secured a $2.49 million order from the U.S. Air Force for their Black Widow systems.
Which are these highly portable, rapidly deployable drone units, right?
Exactly. And they aren't even just operating domestically. They're actively partnering with Ukrainian and Israeli entities to deliver intelligence, surveillance, and reconnaissance tech.
Because the global demand for localized, small-scale drone technology in modern conflict is just insatiable right now. It is a gold rush. And Red Cat has managed to position themselves right at the mouth of the mine.
It is honestly like being a small indie film studio.
Yeah.
You know, passionate group of people making cool movies in a garage, and suddenly, out of nowhere, you get handed the keys to a massive Marvel franchise.
That's a great analogy.
Right. You have the golden ticket. But earning that franchise means you suddenly have to build the infrastructure to produce a billion-dollar blockbuster.
Which is not cheap or easy.
No, it's not. Which leads us to the other side of this dichotomy. Because explosive top-line growth means absolutely nothing if the company goes bankrupt trying to actually manufacture the product.
Exactly.
So let's look at what it is actually costing Red Cat to generate that $15.5 million.
Yeah, this is where the financial reality detailed in the SEC filings gets incredibly sobering. Because to generate that $15.5 million in Q1 revenue, Red Cat's operating expenses were a staggering $29.3 million.
Wait, they spent almost $30 million just to make $15 million.
Correct.
Wow.
When you look at their trailing 12-month net margin, it sits at negative 138.36%.
That is rough.
Yeah, let's break down what that metric actually means for you listening. A negative 138% margin means that for every single dollar Red Cat brings in through sales, they are spending that dollar plus another $1.38 just to keep the operation running.
But why is the cash burn so aggressive? I mean, building drones isn't like building a software app where you write the code once and, duplicate it for free, right?
No, not at all. Hardware is brutally unforgiving. Before you can ship a single drone to the U.S. Army, you have to secure specialized warehouse space. You have to hire highly cleared aerospace engineers.
Right, which aren't cheap.
Not at all. And most importantly, you have to front the capital to purchase microchips, carbon fiber, lithium batteries.
And because they are building for the U.S. military, they can't just buy cheap components from overseas, right?
Exactly. They have to use National Defense Authorization Act compliant supply chains, which are vastly more expensive. So they are burning cash at an alarming rate just to build the physical assembly lines capable of fulfilling these massive new orders.
And because of that massive cash burn, we are seeing a really fascinating disconnect in how the company is valued by Wall Street.
Yeah, the valuation is wild.
Right. Despite being a micro-revenue company bringing in $15 million a quarter, they are sitting on a $1.4 billion market cap.
Yep.
And the stock carries a price-to-book ratio of 5.87, meaning the market is valuing Red Cat at almost 6 times the value of the actual physical assets and cash they currently own.
And it doesn't stop there. The stock also carries a price-to-sales multiple of 25.69.
Okay, now I am going to push back on the panic surrounding these multiples for a second.
Oh, let's hear it.
Because the bull case here is actually quite compelling. If you look at the history of modern tech giants, burning massive amounts of cash up front is practically a requirement for hypergrowth, right?
Sure, in some sectors.
Look at Amazon. Amazon bled money for a decade. They ran massive multi-billion-dollar deficits to build warehouses and logistical infrastructure long before they ever saw a dime of profit.
That's true, they did.
And defense manufacturing is just as capital-intensive up front. You have to build the factories before you can ship the drones. So isn't a 25x price-to-sales multiple just the market accurately pricing in future guaranteed government money? Like, the market knows the SRR program is real, so they are valuing Red Cat based on the giant they will become, not the startup they are today.
That is the exact narrative keeping the stock afloat right now. But comparing Red Cat to Amazon fundamentally misrepresents the concept of operating leverage.
How so?
When Amazon was burning billions, they were building fixed infrastructure, warehouses, server farms, delivery networks. Once those assets were built, they allowed Amazon to scale their sales infinitely with very little extra cost per sale.
Right, the margins got huge.
Exactly, that is operating leverage. Red Cat does not have that.
Because every time they sell a drone, they have to, buy more physical parts to build the next one.
Precisely. The variable costs never go away. Furthermore, a massive portion of RCAT's cash burn is going to ongoing research and development. In the defense hardware market, technology goes obsolete in months, not decades.
Oh, that makes sense. Because of countermeasures and stuff?
Yeah, the drone you build today will be useless against tomorrow's electronic warfare jamming techniques. So they aren't just building a factory once, they are trapped in a permanent cycle of spending millions to constantly reinvent their own product just to keep up with the military's changing needs.
Wow, okay. Which puts that 25 times price to sales multiple in a terrifying new light.
It really does.
I mean, having a 25x multiple without any underlying profit is like driving a car 150 miles per hour on a spare tire.
Yeah, exactly.
The speed looks incredibly impressive to anyone watching on the side of the road, but hitting a single pebble will cause a catastrophic blowout. If RCAT delivers on perfect, uninterrupted, exponential growth, the multiple might hold.
Might hold, yeah.
Right. But if a government check is delayed by, say, 30 days, or supply chain hiccups because of a microchip shortage, that 25x multiple will compress violently.
Oh, the market will instantly reprice them. They will go from being valued as a hyper-growth tech darling to being valued as a struggling, cash-poor hardware manufacturer.
So if this financial engine is running that hot and the vehicle is driving on a spare tire, we need to look at the dashboard. And more importantly, we need to look at the people driving the car.
Definitely.
How are the insiders in the broader market reacting to this immense pressure?
Well, the tension between the top-line growth and the bottom-line cash burn is already showing severe cracks in the stock's technical breakdown.
What are we seeing there?
The stock is currently trading around $9.21. Now, it did just have a recent 5-day bounce of about 11.5%, but if you look at the trading data, that bounce happened on remarkably low volume.
Which is a classic dead cat bounce, right? A brief illusionary recovery driven by short-term traders in the middle of a much larger downward trend.
Precisely. Because if you zoom out, the stock is down 51% from its 52-week high of $18.78, which was set back in March 2026.
Over half of the company's value wiped out in 5 months.
Exactly.
When you look at their recent execution, you can see exactly why institutional investors are punishing them. They have had back-to-back double misses in Q1 and Q2 of 2026.
Yeah, that's a brutal track record.
Let's explain what a double miss is, because it is a really severe signal. It means the company failed to meet Wall Street's expectations on both their overall revenue, the top line, and their earnings per share, or EPS, which is the bottom line.
Right.
In Q1, their EPS was negative 22 cents. Wall Street had forecasted negative 13 cents. That means they missed expectations by 67%.
And a double miss for a company valued entirely on future growth is a severe blow to institutional trust. It signals to the market that management does not have a firm handle on their own internal forecasting or, their ability to execute manufacturing on a promised timeline.
Which makes sense why the stock price is suffering.
Yeah, and that institutional doubt is why Wall Street analysts are currently broadcasting very mixed signals. You have H.C. Wainwright maintaining a buy rating with a $20 price target, clearly still believing in the SRR contract, but then you have Needham cutting their target down to $15, signaling a real reduction in their conviction.
Here's where it gets really interesting, though. Because forget the Wall Street analysts for a second. Let's look at what the people inside the actual building are doing, the executives. The insiders.
Oh, yeah. The insider logs are fascinating.
If you read the public PR statements, management is out there loudly affirming their fiscal year 2026 sales guidance. They are telling the public they are going to hit between $150 million to $180 million in revenue.
Which is an insane jump.
Right. For a company that just did $15.5 million in a quarter, hitting $150 million for the year requires a monumental historic ramp-up in production. They are effectively promising to 10x the business in a matter of months.
Yeah, that is their bold public stance.
But when we pull the insider trading logs over the trailing 90 days, the story changes completely. Over the last 3 months, company insiders have sold 315,028 shares of their own stock.
And do you know how many shares they have purchased in that exact same 90-day window?
Zero.
Not
a single executive bought a single share. I mean, if the people inside the building, the ones who can actually see the real supply chains, the real assembly lines, and the real government contracts, if they actually believed they were about to scale to $180 million in revenue, Wouldn't they be buying their own stock with both hands? Especially when it's sitting at a 51% discount from its highs.
It is the most glaring red flag in this entire deep dive.
Absolutely.
Because insider selling on its own isn't always a terrible indicator, right? Executives have to pay taxes or they diversify their personal portfolios. We see it all the time.
Sure. They need to buy a boat or something.
Exactly. But let's stack the evidence here. You have insider selling of over 300,000 shares. You have absolute zero insider buying. This is happening immediately following 2 consecutive earnings misses, and it is happening during a 50% stock drawdown.
It is the absolute definition of watch what they do, not what they say.
Exactly. When you combine those factors, it signals severe execution risk. It tells you that internal expectations of what the company can actually manufacture and deliver might be vastly different from the $150 million guidance they are feeding to the public.
So with the insiders hitting the exits, the cash burning, and the stock price slashed in half, the clock is effectively ticking. What are the specific milestones that need to happen to keep this entire operation from collapsing?
Yeah, there are a few key things to watch.
Like, if you are an investor or just someone watching the defense space, what is the turnaround timeline you need to be watching?
The path to recovery here is very real, but the window is incredibly narrow. The absolute defining moment for RCAT will be their Q3 2026 earnings report, which is expected in early November 2026.
Okay, November.
Yes, this is the moment where the PR statements have to stop and the hard math has to take over.
Because to justify that $150 million annual guidance, they cannot just report a good quarter.
No, they can't.
They need to report a historically unprecedented quarter. To hit their own targets, Q3 and Q4 need to show a massive revenue ramp.
Yeah.
Specifically, they need to hit a sustained run rate of $35 million to $45 million per quarter.
That is the absolute baseline. A $45 million quarterly revenue print would provide the hard proof that the SRR program and those Black Widow orders are actually converting into physical drones and cold hard cash at scale.
Right.
But revenue alone will not save them. They also have to prove they are fixing the cash burn. We need to see their gross margins expanding toward the 20 to 25% range.
Gross margin being the difference between what it costs RCAT to build the drone and what the Army is paying to buy it.
Right. In Q1, their gross margin was 12.7%. Now, to be fair, that was up from negative territory the year before, so they are moving in the right direction.
Okay, that's a positive.
It is, but they have to sustain that expansion to prove they have a legitimate path to actual profitability, rather than just endlessly burning cash to fulfill orders.
And for those watching the stock charts, the technical signal to look for in November is the stock reclaiming and holding the $12 level on high, sustained trading volume.
Yes.
That specific movement would show that major institutional belief is finally returning, rather than just retail day traders chasing another dead cat bounce.
The technicals have to confirm the underlying fundamentals. If they don't hold that $12 floor, it basically signals that the smart money has completely left the building.
So what does this all mean? We have looked at the incredible top-line growth fueled by the U.S. Army. We have looked at the terrifying cash burn required to build hardware. We have looked at the 25x valuation multiple, and we've analyzed the glaring disconnect between public guidance and insider selling.
It's a lot to weigh.
It is. Let's pull all of these sources together and give the listener a final assessment.
If we synthesize all the data across their filings and market performance, the overall assessment for RCAT Holdings lands at a 4 out of 10.
Okay.
The definitive stance right now is neutral to cautious. RCAT is a highly speculative growth story. The bull case is anchored in genuine reality, They have a U.S. Army program of record backing them, and the demand for military microdrones is undeniably surging globally.
Right, the demand is definitely real.
Yes, but the execution risk, the physical ability to manufacture those drones profitably, is dangerously high right now. Furthermore, that 25x valuation multiple offers absolutely zero margin of safety.
Meaning if they miss expectations again in November, the drop could be catastrophic.
It would be. The smartest play, based on the current data, is to wait on the sidelines. Do not take the public guidance on faith. You must wait for hard empirical evidence in that November Q3 report, proving that the massive revenue ramp is actually materializing and the margins are expanding.
Makes total sense.
Only then can this be treated as a stable investment rather than just a gamble.
It really takes us back to where we started, You want these financial reports to be clean and precise, like an X-ray pointing to a broken bone. But in the world of defense tech startups, you are operating in incredibly muddy waters.
Oh, entirely.
The transition from a garage startup to a defense prime contractor is paved with bankruptcies, and until that cash is actually sitting in Redcast's bank account, even an 849% growth rate is just a number on a page.
Well said.
Thank you all for joining us on this deep dive into Redcat Holdings.
And as you continue to watch this space evolve, I want to leave you with a broader question to mull over. We know modern warfare is rapidly shifting away from multi-billion-dollar stealth jets toward cheap, disposable, and localized drone technology.
Right.
But this raises a vital structural question. Will the Pentagon's famously slow, bureaucratic procurement process adapt fast enough to keep agile, cash-burning startups like Redcat alive? Or will these brilliant innovators simply bleed to death waiting for the government to actually write the checks?